Brad Williams, Frugal Finance. Immunization with interest rate futures. What does that mean? Have we not already seen enough hedging strategies? Somebody's always crunching the numbers. Well, and here is the concept, immunization with interest rate futures. And I suspect we're going to discuss some duration mismatches. Immunization with interest rate futures in bond investing, duration mismatches result in exposure to interest rate risk. For example, a financial institution such as a bank or savings and loan might have an asset portfolio with a duration greater than its liability portfolio. It happens all the time. Even today, with all the tools we have, last year, 2023, Silicon Valley Bank went upside down. Why? Right here, a duration mismatch. A sudden rise in interest rates will cause the value of the assets to fall more than the value of the liability portfolio. As another type of risk, a bond portfolio might be managed to a certain future date, perhaps when a firm's pension liabilities become due. If the duration of the bond portfolio exceeds the time until the horizon date, a swing in interest rates will cause the present value of the bond portfolio to change the interest rate risk. By matching the duration of the assets and liabilities, it is possible for the financial institution to immunize itself against interest rate risk, which we call the bank immunization case. For the bond portfolio being managed to a horizon date, a similar immunization can be achieved by setting the duration of a bond portfolio equal to the length of the planning period. We will call this the planning period case. Often, such immunization is very difficult to achieve. For example, banks cannot simply turn away depositors because they wish to lengthen the duration of their liabilities. With the development of interest rate futures markets, financial managers have a valuable tool to use in futures, one for planning period and one for bank immunization cases. Table 6.23 presents data on the three bonds we will use in the immunization examples, along with data for T-bill and T-bond future contracts. The table reflects the assumption of a flat yield curve, instruments of the same risk level. So we have bond A, bond B, bond C, T-bond futures, T-bill. We have various coupons, maturities, yield, price, and duration. I have three additional examples, and we'll move forward, and I'll explain each. Brad Williams, Frugal Finance. Thanks for watching.